The company I've never heard of, Paul, is called Northrop Grumman. Am I stupid?
Yeah, we've done that one before.
They're from Melbourne.
This is an aerospace and defense company. The ticker symbol is NOC. NOC for Gary. We know nothing about this. If you're watching this later, we know nothing about this company. This has been queued up for us, and we're going to look at it using Paul's 8-pillar stock analysis. We're going to look at the fundamentals of the company, and let's go. Paul, have at it. I can see we got some positive numbers already. Go ahead.
We have a $60 billion market cap, a PE of 13.5, so that's a check mark, and a profit margin of 12% check mark. Now, they pay a dividend by 1.5%, which is almost $1 billion a year. So remember, guys, dividends aren't always secure. I'm going to repeat that over and over. We have to make sure the free cash flow justifies it. And one thing I've been looking at lately is return on assets and return on invested capital. This is pretty decent. We have to compare it to other things, but right now, I like the fact that it's about what the market does, 10%. So it's not what the market's average, but it's what the market does.
This corporation is an American multinational aerospace and defense company with 90,000 employees. They say their annual revenue is in excess of $30 billion, and they're one of the world's largest weapons manufacturers and military technology providers based out of Colorado. Go ahead, Paul.
$25 billion 5 years ago, $37 billion in revenue, check mark. Now, one thing I noticed, the profit has gone from 2.1 to 4.5. Guys, this is why Uncle Paul is here for you.
Tell me.
I happen to be scrolling down. Special income and charges. They made an extra $2 billion in the last 12 months for something. So this $4.5 billion here should really be around $2.5 billion. Find out what this $2 billion net income addition was. Maybe they sold a division, maybe they sold something that made them $2 billion. This should not be included in their PE. So their PE is a little misleading because it shows 13, but they've almost doubled their income. It should be more around 25. Keep that in mind, guys.
So pillar number 3 was revenue growth. That's a check. It is increasing. And that elevated profit growth, we've got to be careful. It is a check for pillar number 4.
It would still be a check even if you took the $2 billion out.
You're right.
But it's still a little exaggerated.
Pillar number 5 is shares outstanding. We want this company buying their shares back and not selling off.
And they sure are. 175 million down to 163. And very consistent, too. Even going back 10 years. Every single year, their shares are going down, Seth. And we're doing a video here soon.
Yes.
This is actually my favorite pillar.
Mm-hmm.
Shares outstanding is my favorite pillar. Because, why is that? It's the most overlooked one. It's the one everybody, and it's one of the ones that can hurt you the most. It is my favorite pillar, probably even more than cash flow. Not in terms of I'm making a decision based on it, but in terms of how I see people not understanding it very well.
Pillar number 6 is current assets over current liabilities, Paul, and it's getting hot in here because 5 straight checks, my friend.
5 straight?
Yes.
12.25 billion to 8.4 billion. Let's keep that check train going.
Check, please.
Okay, that's 6 straight. Free cash flow growth.
And remember, guys, for all of you people who pay for the 80 cents a day to get access to this amazing software that's only getting better and only going to get more, I added this free cash flow line to the cash flow statement. It's not in here. It's not supposed to be in here, but I do it to make it easier for you guys. We go from 1.6 billion to 3.88, check mark there with an average of 2.4. Yep. Now remember, I'm sure this 3.88 includes that $2 billion gain they had in there, but still with an average of 2.4 billion times 20 is $48 billion, which is an X then. It's the final one. It's a $60 billion company. And we're looking at 20 times. And I don't think this justifies 20 times free cash flow. I always pick 20 as a starting point. If you take the average of the last 5 years, if cash flow is growing, you should be willing to pay a premium. So I picked 20 as an average of the last 5 years. The average of the last 5 years here on free cash flow is 2.4 billion. Multiplied by 20 is 48 billion, which means if you paid $48 billion for the company today, and they did about the average for the rest of the time they've done in the last 5 years, you're going to make about 5% a year. But it should be increasing. So as it increases, you'll be making a higher and higher return as time goes on. Now, there are things I like about this company. They have a higher return on assets and a higher return on invested capital. It means the money they put into the business, they've done a good job of getting a return on. The thing I don't like about this company is that PE is misleading. Now, the good news is their dividends are about $950 million. So they do have enough money to pay their dividend year in and year out. But it's not a huge dividend, only 1.5%. Am I in love with this company? No. But am I putting it on a radar? Absolutely, because it is selling for probably closer to the mid-20s in PE, and it's not going to take much for it to drop to a price that makes sense for you. And I do think that paying around first off, find out what this free cash flow last year of $4 billion. Let's see how much of that was. Yeah, it was because of oh no, I'm sorry, that was taking out the one-time gain. So that's pretty good, guys. I kind of like this. Now, I still don't want to pay $60 billion for it, but if you paid $60 billion for it now, based on last year, and you thought last year was stable, you're getting it for about 15 times free cash flow almost, maybe 16. Not terrible, but I would want to buy a mature company like this, especially one that relies on the government, at a little bit lower multiple.
Laura's asking, do you use the same ratio for free cash flow if you average for 10 years?
No, I'd use a higher ratio. Because the idea is this, Laura. It's a great question, and I want to discuss this right now. If you have free cash flow of $1, $2, $3, $4, $5, what's your average? The average is 3, right? Now, if you add another 10 years to it, 6, 7, 8, 9, 10. Now, your average here is 3 when your most recent year was 5. Your average here, which is 66% higher, your average here over the last 10 years is 5.5 versus 10. It's almost twice as much. So you have to give yourself a bigger multiple because of the fact that it's so much different than the actual last year's free cash flow. In an increasing cash flow perspective, you have to give a higher multiple. If it's decreasing, a lower multiple for reasons like this. Does that make sense?
Mo, how's the trading view looking for trading Northrop Grumman?
So with Northrop Grumman, I mean, I'm just looking back at, this is a 2-year chart. So they've just had a very difficult time breaking out, and they're kind of at that 370, 385 was their biggest resistance point. So
it looks like we're over that 80% stochastic
over
on top
80%,
down there,
kind of in that overbought range. It is a power stock right now. It's not up here, but it is over all of its major moving averages. So if you're in this, great job. I mean, you could have rode this thing all the way up to where it's at right now. And if you are still in it, stick with it. As long as you just keep going sideways like this, you're perfectly fine. This is a great looking stock. I mean, it's defense, so a lot of money's put into defense in this country, and that's why it keeps going. If you're in it, I wouldn't do anything until you get like an engulfing candlestick like that, going to new highs, breaking out over that, I think the 385 area is the resistance point. So if you can get through that, keep adding to it and keep it going. No reason to panic with this thing.
Paul, the stock is currently at 372. What kind of target price are you thinking now? Wait, what do you?
Now remember one thing: they're buying shares back very consistently. One of the things we're going to put in the stock analyzer tool is factoring in their buying back of shares. You can't just look at the multiple when they're buying back shares. If they're buying back shares and they're reasonably priced, this is a good thing. I still think probably 300 or so, probably a better price for this, where you can expect to make a and this is my off-the-cuff number. But buying back their shares is going to help you out long term if you believe this company is only going to do better as time goes on. And remember, guys, you don't need massive growth to make good money in a company like this. You just need to make sure they're paying down debt, buying back shares, paying out their dividend, and just getting a little bit better every single year.
That's our take, guys. Yeah, okay, awesome. Again, guys, it's a $15 donation today. The donations will go toward where again, Paul? My apologies.
St. Jude's.
Can I ask Paul a question real quick?
Go ahead.
Yeah.
Because it's defense sector, do you look at it any differently?
You know, these are part of the qualitative aspects you have to look at the company.
Yeah.
I prefer not to buy companies that are heavily reliant on the government.
Right.
Because
that's why I'm asking.
An administration could change, but you know, I mean, at the end of the day, it's still. By the way, I just watched the movie War Dogs recently. Incredible movie.
I watched it on Monday, I think. The reason I asked it is because we exclude sectors like insurance, energy, this and that. So I was thinking maybe defense is another one, but that's all. Okay.
Thanks so much for watching the video. We hope you were intrigued. If this style of investing speaks to you, click the link below to join our Patreon. As a patron, you get access to a wonderful community of like-minded investors where you can chat, connect, ask questions, and share ideas with badasses like you all over the world. The best part is you get the amazing Everything Money software. This is revolutionary, unlike any YouTube page. You can track your investments, look at stocks, and quickly run our 8-pillar analysis on any company you like. The top tier patrons get direct access to Paul and Trader Mo. You'll see their daily trades, their updated portfolios, and every options contract they write on a daily basis. We provide Patreon exclusive videos just for you, including live streams and exclusive content from our team. Our bottom patron tiers fill fast, so join today. But hey, if you don't believe me, look at all of our patrons' amazing success stories. In comparison to other financial platforms, our software is by far the best value. This is your chance to get serious about investing. If you're finally ready to level up your investing game, join our Patreon and let's start kicking ass together.